What if I told you that one of the most popular dividend ETFs, SCHD, is no longer the king of the hill? Yep, the Schwab U.S. Dividend Equity ETF, or SCHD, might finally be facing some serious competition. And it's coming from a relatively under-the-radar dividend ETF, FDVV, also known as the Fidelity High Dividend ETF. Investors have been obsessed with SCHD for years, and for good reason. It's simple, it pays well, it has solid holdings, and it has crushed expectations in the past. But now, in 2025, the question on many investors' minds is SCHD slipping? And more importantly, should you consider FDVV instead? Let's dive in and find out. First, let's talk about SCHD's core appeal. SCHD focuses on high-quality U.S. companies with a strong record of paying and growing dividends. Think of it like the reliable workhorse of dividend ETFs. It tracks the Dow Jones U.S. Dividend 100 Index and screens for profitability, earnings growth, and solid dividend payouts. Its biggest holdings? You've got names like PepsiCo, Merck, Home Depot, and Verizon, all massive companies with consistent cash flows. Now, performance-wise, SCHD has historically delivered total returns of around 12% annually over the past decade, combining dividend income and capital appreciation. In fact, during the 2020 to 2022 boom period, it gained a cult following for outperforming even the S&P 500 at times. But in 2023 and 2024, things began to shift. Rising interest rates changed the dividend landscape. Investors started demanding higher yields from their dividend holdings to keep up with Treasury bonds. SCHD, which has a current yield of around 3.5%, started to look a little underwhelming. At the same time, SCHD's sector allocations worked against it. It's heavily weighted toward industrials, consumer staples, and financials, sectors that haven't exactly been on fire lately. And while that defensive allocation is great during a downturn, it can also mean lagging performance during growth rebounds. Enter FDVV, Fidelity's High Dividend ETF. Ticker symbol FDVV has quietly climbed the ladder and is now on a lot of savvy investors' radar. FDVV tracks the Fidelity Core Dividend Index, which focuses not just on yield, but also on dividend sustainability and growth potential. It casts a wider net, including large, mid, and even some small-cap U.S. stocks. And here's where it gets interesting. FDVV's yield is currently above 4.1%. That's higher than SCHD. Plus, in 2024, it posted a total return of 14.7%, beating SCHD by a noticeable margin. Its top holdings include Apple, Microsoft, JP Morgan Chase, and Johnson & Johnson. Right away, you can see the contrast. FDVV includes more tech exposure, while SCHD stays away from it. And that tech exposure has been a huge deal. In a market driven by innovation, AI, and cloud computing, having Apple and Microsoft in your dividend ETF isn't just a bonus. It's almost a necessity. Let's break down the numbers. Over the past year, SCHD yield approximately 3.5%, total return approximately 10%. FDVV yield approximately 4.1%, total return approximately 14.7%. That's a serious outperformance. And it's not a one-off. If you compare trailing 3-year total returns, FDVV has started catching up in a big way. So why haven't more investors jumped ship from SCHD to FDVV? Well, SCHD still has a powerful brand. It's got a low expense ratio, just 0.06%, while FDVV charges 0.29%. And in the world of long-term investing, that 23 basis point difference can add up. Also, SCHD's strategy is crystal clear. Quality over quantity with strict screening criteria. Some investors like that level of discipline. But FDVV isn't just spraying and praying. It still screens for quality dividends and it rebalances quarterly to adapt to changing market conditions, something SCHD doesn't do quite as often. And when it comes to sector diversification, FDVV has a clear edge. While SCHD is concentrated in just a few sectors, FDVV spreads its exposure more evenly across tech, healthcare, energy, and financials. That balance has helped it weather the volatility of recent markets and outperform during growth rebounds. One more advantage of FDVV, it pays monthly. That's right. Unlike SCHD's quarterly dividend payouts, FDVV pays its investors every single month. For anyone building a passive income strategy, that's a game changer. Imagine having cash flow every month without needing to time your budget around quarterly distributions. All right, let's address the elephant in the room. Is it time to dump SCHD and go all in on FDVV? Not necessarily. SCHD still brings a lot of value to the table. Its low fees, strong track record, and consistent strategy make it a solid long-term core holding. But investors need to be honest about its limitations, especially in today's market environment. FDVV, on the other hand, offers higher yield, broader exposure, and monthly income. It's growing in popularity for a reason. As of 2025, FDVV's assets under management crossed $3.2 billion, and that number is climbing fast. One strategy that might work well for long-term investors? Use both. You don't have to pick sides in this ETF showdown. A 60-40 split, 60% SCHD, 40% FDVV could give you the best of both worlds. You'd get SCHD's stability and quality filters with FDVV's monthly cash flow and growth potential. Let's say you had $100,000 to invest. Putting it all into SCHD might give you $3,500 per year in dividends, paid quarterly. Putting it all into FDVV might give you $4,100 per year, paid monthly. A 60-40 split could generate about $3,820 annually, smoothing out income with monthly payments and slightly boosting your yield. And over time, you can rebalance between the two, depending on performance and market outlook. But here's the bottom line. SCHD is no longer the undisputed champion of dividend ETFs. FDVV is not just a viable alternative, it's a real contender. In some respects, it's already beating SCHD. And with Fidelity behind it and smart indexing strategies at work, it's poised to keep growing in relevance. So, if you've been sleeping on FDVV, now's the time to give it a closer look. And if you're all in on SCHD, it might be time to rethink your strategy, at least a little. That's it for today's video. If you found this breakdown helpful and want more Real Talk ETF content, delivered stickman style, smash that like button, subscribe to Money Stick Unfiltered, and tap the bell icon so you don't miss out on the next video. See you next time.